Every single day, millions of Americans walk into car dealerships and sign contracts that will keep them trapped in debt for years. They focus on the monthly payment. Can I afford $400 a month? And they ignore everything else. The salesperson smiles, nods, and hands them a 72-month loan at 10% interest. The buyer drives off feeling victorious. 6 months later, they owe more on the car than it's worth. They're upside down. Then they want to trade it in, but they can't. They're trapped. This cycle repeats for decades, but it doesn't have to. There's a simple, powerful rule that the car industry hates, the 24-10 rule. And if you follow it, you will never get upside down on an auto loan again. If you stay until the end of this video, you'll learn exactly what the 24-10 rule is, why it works, and the simple math that protects you from negative equity. I'll show you how to calculate your maximum affordable car payment, how to negotiate based on total price, not monthly payment, and what to do if you're already upside down. By the time we're done, you'll never be a victim of predatory car financing again. My name is your name, and today we're going to make sure your car builds wealth, not debt. Let me start with a story that will sound familiar to anyone who's ever bought a car. A few years ago, a client named Jessica came to me. She was 28 years old, earning $50,000 a year. She had bought a brand new SUV for $40,000. She put zero down and took a 72-month loan at 9% interest. Her monthly payment was about $720. She thought she could afford it. After 18 months, she had paid over $12,000 in payments, but her loan balance had only dropped by about $5,000. The rest went to interest. Then she had a minor accident. The car's value dropped. She owed $32,000, but the car was worth only $25,000. She was upside down by $7,000. She wanted to sell the car and buy something cheaper, but she couldn't. She would have had to bring $7,000 cash to the closing table. She felt trapped. She was paying $720 a month for a car she no longer wanted. That's when she found me. I introduced her to the 24-10 rule. She realized she had broken every part of it. She put $0 down instead of 20%. She took a 72-month loan instead of 48 months. And her car payment was 17% of her gross monthly income instead of the recommended 10%. No wonder she was struggling. We worked together to pay down the loan aggressively. She got a side hustle, sold some belongings, and put every extra dollar toward the car. Within 14 months, she was no longer upside down. She sold the car, bought a used Honda Civic for $12,000, and paid it off in 2 years. She now has no car payment and is investing the money she used to spend on payments. Her net worth is climbing. She told me, the 24-10 rule saved my financial life. The 24-10 rule is a simple guideline for responsible car buying. It has 3 parts. The 20% down payment, build instant equity. Put at least 20% down on the car. If you're buying a $30,000 car, that's $6,000. Why 20%? Because new cars typically depreciate 20–30% in the first year. By putting 20% down, you ensure that you have immediate equity in the car. Even after driving off the lot, you owe less than the car is worth. You are not upside down. If you get into an accident, your insurance payout will cover the remaining loan. If you need to sell the car unexpectedly, you won't have to bring cash to the table. If you can't afford a 20% down payment, you can't afford the car. That's the rule. Don't rationalize. Don't look for loopholes. If you don't have $6,000 for a $30,000 car, buy a cheaper car. The down payment protects you from negative equity. It's not a suggestion, it's a requirement. The 4-year loan term, pay it off quickly. Finance the car for no more than 4 years, 48 months. Why? Because car loans longer than 48 months put you at risk of being upside down for years. In a 72-month loan, you pay mostly interest in the first 2 to 3 years. Your principal barely moves. Meanwhile, the car is depreciating rapidly. By the time you're halfway through a 72-month loan, you could owe more than the car is worth. Then you're trapped. With a 48-month loan, you pay off the car faster, build equity faster, and pay far less interest over the life of the loan. Let me show you the difference. A $30,000 loan at 9% interest for 48 months costs you about $746 per month. Total interest $5,800. The same loan for 72 months costs about $540 per month. Total interest $8,900. That's an extra $3,100 in interest. And you're stuck with the car for 2 more years. The lower monthly payment is an illusion. You pay more in the long run and you carry more risk. The 10% of gross income cap keep payments affordable. Your total monthly car expenses, payment, insurance, gas, maintenance, should not exceed 10% of your gross monthly income. If you earn $60,000 a year, your gross monthly income is $5,000. 10% is $500. That's your total car budget. If your insurance and gas cost $200 a month, your payment must be $300 or less. This rule forces you to be realistic. You can't finance a $40,000 car on a $50,000 salary. The math doesn't work, and the salesperson who says you can afford the monthly payment is ignoring insurance, gas, and maintenance. They want you to focus on the payment alone. Don't fall for it. Use the 10% rule to determine the maximum payment you can afford, then work backwards to find the car price that fits. The math: from income to affordable car price. Asterisk. Let me give you a simple formula. Take your gross annual income, multiply by 0.10. That's your maximum annual car expenses. Divide by 12 for your monthly cap. From that cap, subtract your estimated monthly insurance, gas, and maintenance. The remainder is your maximum monthly payment. Then use an auto loan calculator to find the car price that fits that payment with a 20% down payment and a 48-month term at current interest rates. For example, you earn $60,000. 10% is $6,000 per year, $500 per month. Insurance and gas cost $200, so your maximum payment is $300. With a 48-month loan at 7% interest and a 20% down payment, a $300 payment buys a car worth about $15,000. That's your budget. Not $30,000, not $25,000, $15,000. That's a reliable used car, not a new SUV. That's the reality of responsible car buying. Asterisk. Why the 24/10 rule protects you from being upside down. Being upside down means you owe more on your car loan than the car is worth. This happens when you have a low down payment, a long loan term, and high interest. When you're upside down, you're trapped. You can't sell the car without bringing cash. You can't trade it in without rolling negative equity into a new loan, which makes your next car even more expensive. The 24/10 rule prevents this by ensuring you have immediate equity, 20% down. You pay down the loan quickly, 4 years, and you don't overextend your budget, 10% of income. You will never be upside down if you follow this rule. What if you're already upside down? How to escape? If you're already in a bad car loan, you're not alone. Here's how to escape. First, stop the cycle. Do not trade in the car and roll negative equity into a new loan. That's like digging a deeper hole. Second, find out exactly how much you owe and what the car is worth. Use Kelley Blue Book to get the private party value. The difference is your negative equity. Third, accelerate your payments. Pay extra principal every month. Even $50 a month can shorten your loan and reduce interest. Use any windfalls, tax refunds, bonuses, gifts to make lump sum principal payments. Fourth, consider selling the car privately. You may get more than the trade-in value. If you can sell for more than you owe, great. If you still owe more, you'll need to bring cash to the table. That's painful, but it's better than staying trapped for years. Fifth, after selling, buy a cheap used car with cash or a small loan that fits the 24/10 rule. Then rebuild your finances. This is a short-term sacrifice for long-term freedom. The new car versus used car decision. The 24/10 rule applies whether you buy new or used. But used cars are much more likely to fit the rule. A $15,000 used car with a 20% down payment $3,000 and a 48-month loan at 7% interest gives you a payment of about $300. That fits the $60 Zusan income example perfectly. A $30,000 new car would require a much higher income or a much higher down payment. Unless you have a high income, stick with used. The interest rate trap. Know your credit score. Your interest rate dramatically affects your payment. A 48-month loan on $24,000 after 20% down on a $30,000 car at 5% interest is $553 per month. At 10% interest, it's $609. That's a $56 difference per month, 2,688 months over 48 months. If you have poor credit, do not finance at a high rate. Instead, buy a cheaper car with cash or work on improving your credit before buying. The 24/10 rule assumes you can get a reasonable interest rate, 5-7% for good credit in 2026. If you can't, save up and pay cash. The 2026 interest rate environment. In May 2026, average auto loan rates are about 7% for new cars and 8% for used cars for borrowers with good credit. Subprime borrowers are paying 12 to 15% or more. If you have good credit, you can find competitive rates at credit unions. Use an online aggregator like Bankrate to compare. Always get pre-approved before going to the dealership. That way, you know your maximum loan amount and you're not pressured into the dealership's financing. The negotiation strategy. Focus on total price, not monthly payment. Dealerships love to talk about monthly payments. Can you afford $400 a month? They will adjust the loan term and interest rate to make the payment fit while hiding the total cost. Your job is to negotiate the total price of the car, not the payment. Once you agree on a price, then you discuss financing. If the dealer insists on talking in payments, you are in control. The one exception, when you have no choice. Asterisk. There are rare situations where you need a car immediately and can't follow all the rules. If your car dies and you need transportation for work, you may have to take whatever financing is available. In that case, follow the rules as closely as possible. Put down as much as you can. Take the shortest loan term you can afford, and plan to refinance as soon as your credit improves. Then work to pay off the loan early. The 24/10 rule for leases, why it doesn't apply. The 24/10 rule is for buying, not leasing. If you're considering a lease, watch my video on why you should never lease. Leasing is the most expensive way to operate a car, but if you must lease, use a modified rule. Put as little down as possible. Money down on a lease is lost if you total the car. Keep the lease term to 36 months and keep your total lease payment under 10% of your income. But again, just buy a used car. A real story. How the 24/10 rule changed a family's finances. I want to tell you about a couple, Tom and Sue. They had 2 car payments totaling $2,200 a month. They earned $100,000 a year. Their payments were 14% of their gross income, above the 10% rule. They were stressed. They followed the 24/10 rule. They sold 1 car and paid off the loan. They kept the other car and accelerated payments. They saved up $6,000 for a down payment and bought a used car for $20,000 following the rule. Their combined car expenses dropped to $600 a month. They invested the $600 savings. After 5 years, they had $45,000 in their investment account. They told me, "We thought we needed expensive cars." The 24-10 rule showed us we were wrong. Your action plan: do this today. Here's what you need to do. First, calculate your 10% number. Multiply your gross monthly income by 0.10. That's your total car budget. Second, subtract your estimated insurance, gas, and maintenance from that number. The remainder is your maximum monthly payment. Third, use an auto loan calculator to find the car price that fits that payment with a 20% down payment and a 48-month term at current rates. Use a rate of 7% for good credit. Fourth, if you're already in a car loan, check if you're upside down. Use Kelley Blue Book to estimate your car's value, compared to your loan balance. If you're upside down, make a plan to accelerate payments. Fifth, if you're shopping for a car, get pre-approved at a credit union before going to the dealership. Sixth, commit to never signing a car loan that violates the 24-10 rule. Write it down. Put it in your wallet. Savant, comment below. My 2410 number is Khan. I'll reply to the first 100 comments. If this video saved you from a bad car loan, hit the like button. It helps others avoid the trap. Subscribe and turn on notifications. This is the final video in this series, but I'll be back with a new series on real estate investing and tax strategies for high-income earners. The 2410 rule is not a restriction. It's a liberation. It frees you from the cycle of car debt and negative equity. Follow it, and you will never be upside down again. Your wallet and your future self will thank you. I'll see you in the next series.